Hello and good afternoon, everybody. Thank you for joining SSQ's webinar series for the month of September. I can't believe we are already into the September month, and fall is definitely just around the corner. I am very excited to present to you today on our Smart Beta Plus portfolios. Firstly, I wanted to just quickly introduce myself. My name is Sam Alves, and I am the Director of Insurance and Investments for the Greater Toronto Area. My inside sales representative is Sheldon Fresh, who you heard earlier, providing us with our introduction. And I have my partners across Ontario, in the East and Northern Ontario, Barry Rubin and Safina Silverman would be your contacts. And also in the Greater Toronto Area, there is also Sean Redford and Gordon Chan. And for Southwestern Ontario, we have Lynn Giles and Sally Saint-Leger. And for the Ottawa region, we do have Sharon Hiller and Josiane covering for the Ontario or Ottawa region as well. So today I'm going to cover our Smart Beta portfolios. That being said, I first want to cover SSQ's overall guarantee structure. So if you are thinking of using SSQ for the first time, this will give you an idea of what type of guarantees that we do offer. A little bit of background on SSQ as a investment company. So essentially, we are a manager of managers, okay? So all the funds that are available within our portfolio are third-party managed. So there's no in-house managers, there's no in-house mandate. So we are very diligent when it comes to ensuring that we are providing you the best investment opportunities to your clients. We are making sure that the funds are continuing to perform versus their benchmark and their peers. So we really do our due diligence when we do bring on a new fund of families to our portfolios, as we did with the Smart Beta not too long ago. And everything is really done strategically to be able to enable you to work with your clients, build portfolios that covers many different asset classes, investment approaches, whatever your client's risk tolerance may be. We want to make sure that we are able to provide them a solution that can help grow their assets long term, okay? Also, I also want to touch upon quickly our commissions. What typically is the most popular type of commission structure that is being used within SSQ when advisors are selling us, okay? So we'll start with the guarantees. Our guarantees are all available through our website at ssq.ca under investments. So if you go under the website, all that contact information would be readily available for you there. But we'll start with the basic strategy, okay? So the basic is a 75-75. This is ideal for anybody who really wants to keep their costs down, okay? Or if you're looking at a younger client that isn't really concerned about resets or on maturity or upon death, this is a perfect type of strategy or guarantee that you can use for them, because it's going to only charge you the management expense ratio. There's no additional surcharge for insurance coverage on the product, okay? So the basic guarantee is probably one of the most popular used strategies just to keep the cost of insurance down to your clients, okay? Secondly, we have our optimal guarantee. So, our enhanced, I should say, our enhanced guarantee, which is our 75-100, okay? This also is quite popular. The account can be opened up prior to age 75, and it provides your client with 100% death benefit, which is very, very important for those clients who are looking at estate planning and want to have that security upon death for their beneficiaries. So the 75-100 is also quite popular. You do get an additional charge for the guarantee on the 100% death benefit. And thirdly, really our sweet spot here at SSQ, I find, is our optimal guarantee. So this is our 100-100. And what really makes this guarantee unique is the availability of which you're able to open the account up until, okay? Traditionally, 100-100s are typically about age 80 and sometimes even younger when it comes to opening up the accounts. So with the 100-100 here at SSQ, you can actually open it up just prior to the client's 85th birthday, okay? The minimum to open up any account here at SSQ is $400, whether that's a lump sum payment, or they can set up a pack for $40 per month to open up an account, okay? So again, that's $400 as a minimum purchase to open up any account. So even if your client doesn't have a direct need at the current moment for a 100-100, we are seeing an aging population in our demographics. So we are seeing a lot of people now selling their homes, downsizing homes, and we know the price of real estate has gone up substantially, and we're seeing that the seniors are sitting on a lot of non-registered funds that needs a named beneficiary to help them with estate planning when it comes to getting money to be bypassed through probate. We know that this type of product is needed in the marketplace. So if you have a client who doesn't have an immediate need, but you know, maybe they're selling their home, they're selling a property in a year or two, why not open that account? You can make deposits up until age 100 on the 100-100. 100% is guaranteed, like I mentioned, and it is very, very popular. A lot of advisors are using us for this particular guarantee because it's very unique in the marketplace. We don't limit you on the fund selection as well. So if you wanted to go 100% equities, you can do so with our 100-100 as well. That tends to be kind of a sticking point with other providers where it's a fairly limited range of funds that is being offered in the 100-100 guarantee, whereas SSQ, we're not restricting you. There are only two funds that you cannot use, and that are the infrastructure fund, alternative class funds, and a global real estate fund. But fortunately, you can actually gain exposure through our Celestia portfolios, which I'm actually going to be covering shortly within this presentation as well, okay? And lastly, the commission structure. We all know that we have to get paid. We offer the full range of front load, no load, your traditional DSC. But what I really wanted to highlight today was our no load mode B. And that is a very unique type of offering in that we're going to pay the advisor 3% upfront, okay? There is no trailer for the first 24 months of this particular sales structure, but you will get a full 1% starting in the 25th month. And the beauty of this particular load structure is that there's no chargeback to the client. So there's no DSC charges. It's completely a front-end product to your client. There is a prorated monthly chargeback to yourself as the advisor should the client redeem within that 24-month period. Another advantage of SSQ's contracts, we don't restrict you in terms of sales structures or payouts within one contract. So what that means essentially is if you wanted to mix and match between the no load mode B and let's say the a no load load structure, you can do so. So you can do multiple payout structures within one contract to yourself. So that way you have funds that are available immediately to your client should they need access to it, or if they want to have something long-term, you can also place it as such within that one contract, okay? So I'm going to get into now the smart beta portfolios. Like I mentioned, very, very excited that we brought this type of strategy onto our platform. I have been very, very happy with the overall performance and the overall sentiment that I've received from advisors in selecting and them using the smart beta portfolios. So we're going to get into why we offered a new family of funds, okay? For those who aren't familiar, here at SSQ, in terms of our portfolio funds, we had a couple of options available for you, okay? So the first one was the strategy. Okay, this is kind of the vanilla strategy. It's your traditional actively managed portfolio fund. It has automatic rebalancing. It has to stick within certain criteria in terms of asset mix between 60-40 equities, and it will not deviate from that. Very, very standard in the industry for those who like that traditional active management, okay? Then we offered our Celestia portfolios, right? So you get a little more flair with our Celestia portfolios, both active management strategy. But what really separates the Celestia from our strategy funds is that we actually have alternative class funds, which is an infrastructure fund and a global real estate fund that overall lowers the potential of risk to the portfolio, given the two alternative class funds that are being added to these two portfolios, okay? So you have the Celestia and you have the strategy. Now, we brought in the smart beta, okay? So smart beta strategies really became popular over the past few years. You've probably heard the word smart beta if you are in the investment world. We know that it's definitely kind of a hot word where people like to talk about smart beta and talk about the benefits of smart beta and how it can actually diversify your overall portfolio, okay? So basically what the smart beta does, it essentially offers you higher returns with lower risk, okay? We're going to get into the management of it, how it is constructed in terms of the portfolios. But it really is a nice strategy that you can offer to your clients to a platform that already covers both an active management style, and now with the smart beta, as it does have a passive component to it as well. There's always been the debate, what is the best strategy? Is it active? Is it passive? And to be quite honest with you, I think there's merits for both strategies. And that's what I really like about this particular product. It enables you to have an active management component and a passive strategy as well. That really, really enables you to get some of the best risk-adjusted returns in the marketplace today, okay? So SSQ is actually the first insurance company in Canada to provide a smart beta plus portfolio in a single investment solution. So that is really, really exciting that we were able to bring this to our Canadian investors and to the insurance platform. So smart beta strategy, a new way to capture the market, okay? So what is smart beta? So smart beta strategy uses alternative index construction rules to achieve specific objectives instead of the usual market capitalization weighting, okay? So what does that mean, all right? So typically when you're buying a passive type of strategy, i.e. an index fund, the market caps are pretty much set by the index itself, by the concentration risk that is, or the concentration of individual securities, sorry, to the respective indice that you are buying. So the smart beta uses an alternative. So it's not going to follow the traditional market cap that you would get in a regular index fund. We're going to try to remove some of the risks that comes with index investing and provide you somewhat of a active management approach, still within an index type of structure, okay? So that's really, really exciting for those who do like that passive management approach. This offers them a little more security. And the main objective really is to maximize, again, you're going to hear this over and over again, that risk return ratio, okay, to the portfolio. So the portfolio is also rebalanced, and it's predetermined at times based on specific factors by adding or removing securities, all right? We're going to get into what does that entail shortly, and how that selection process is completed with that smart beta strategy. So when a portfolio manager puts this particular portfolio together, they're going to be looking at a few different factors, okay? So the first one, as I mentioned earlier, by underweighting or removing the most volatile securities, all right? So when you're typically buying your index fund, you're buying the index as a whole, you really don't have the option of being able to remove an individual security that is very volatile within that index, right? So what we're able to do is we're able to create an index that removes those most volatile securities, so reducing the overall risk of your client's portfolio. We also like being overweight underpriced securities, okay? So if we're seeing that there is underpriced securities and they are a good fit for the overall portfolio, we may be overweight on those particular securities, okay? Now, weighting could be based on one or more several factors. It is used to optimize diversification according to the risk return ratio based on a specific investment or specific objective, okay? So instead of choosing securities by sector, geographical area, or management style, smart beta strategies uses one of the several following factors, okay? So we're gonna look at the overall market, okay? Momentum, is there anti-momentum going on in the marketplace at the moment? So we're really gonna try to take advantage of those swings in the marketplace when it comes to a momentum, or even on a down market availability as well, okay? So you're getting that active management and that readjustment based on momentum. And we know that the market is very, very much influenced by the news that's released, either obviously through the happenings of the US government or here in Canada. So we're going to take advantage of those opportunities. We're also going to look at large and small cap equities, okay? So it's really, really going to provide you a diversified type of equity exposure. So it's not going to limit you just to a large cap, mid cap, or small cap. It's going to offer you whatever opportunity is best for the portfolio. We're also going to be looking at value and growth funds as well. Dividend funds. We're going to look at the overall quality of individual companies that we're bringing on to the portfolio as well. And the overall volatility, which is a common theme with the smart beta, is keeping volatility down. Smart beta is a great strategy for those who want a lower volatility type of investment vehicle. So we're going to look at all these different factors when constructing these portfolios. So we're going to take a quick overview of the smart beta strategy, okay? So we're going to look at the traditional method versus the smart beta strategy. So market cap weighting on a traditional market, or traditional fund, I should say. So construction system is based on the issuer size or the market capitalization, right? The smart beta strategy uses an alternative index construction rules, okay? Again, we're gonna be underweight on the higher volatile funds and probably more overweight on the underpriced values as well, okay? So securities weighing in on the indexes varies according to their market capitalization, all right? So we also know that on the smart beta strategy, we're always going to try to achieve a better return than the traditional index with lower volatility for a better risk adjusted return, okay? On the traditional market, the higher the price of the security or the sector, the greater the concentration risk is to the index as well. We all know what happened back with Nortel, the heavy concentration risk from Nortel. If you were in an index fund, you rolled that stock down just as if you bought it individually as well, okay? So we know that concentration risk is very, very key. It's a component that typically gets overlooked in some portfolios, but is one of the reasons we actually brought in the smart beta strategy, because at the time we did see some concentration risk in the stock market, and we wanted to be able to offer our clients an alternative to that, so that they are protected when it comes to concentration risk as well. Okay, the smart beta strategy also replicates an index based on one or more several factors, which we've covered. It has better asset allocation. Again, concentration risk is reduced as well. Okay, so those are really the main differences between the traditional method and the smart beta. So to summarize, it's essentially we're always looking for the best risk-adjusted return. We're gonna, again, try to make sure that we're bringing you lower volatility with higher returns when it comes to the smart beta strategy. Your traditional method, the takeaway is concentration risk is always a risk that you clients and investors must be aware of, and something to look at when you are considering a portfolio for your clients, okay? So those are really the big takeaways from the traditional method and the smart beta strategy that we offer here. Luckily for us, like I mentioned, SSQ offers both your traditional active management and a passive strategy management, so you can really get the best of both worlds when it comes to different investment strategies. So we're going to take a look at what we call the core satellite approach, all right? So this is essentially the DNA of our portfolio fund here with our TD Smart Beta Plus portfolios, okay? So we have what we call the core of the portfolio, all right? So that's gonna be our global investment grade bonds, our global high yield bond, our US equity exposure. You're gonna get some terrific low volatility global equity exposure and some really good emerging market equity exposure as well. What you're looking at is some really, really good cross diversified asset classes, income classes that will provide your clients superior risk-adjusted returns in the marketplace, okay? The beautiful thing about this product, as I mentioned, we also have an active managed approach to it as well. This is so key. So for those who do still like that active management approach, we are offering that in our Canadian equity and bond exposure, okay? So you're gonna have the managed portfolio. We're gonna get into the fund managers in a little bit, but you got some Canadian bond exposure and you have the Canadian equity exposure as well, okay? So the core satellite approach is an optimal strategy overall. So the core, or the quote unquote smart beta portion, is composed of the passive management for foreign investments. So the satellite or the plus portion consists of two actively Canadian managed funds. The Canadian market, we know, is actually a lot smaller than the US and global markets and is less liquid and less efficient than other markets. We know that the Canadian markets are also heavily concentrated in resources and also in financials. So there is opportunity within the Canadian market, but it is fairly limited. But the active management is definitely a better way to play the Canadian market, in that the portfolio manager can try to generate excess returns versus the index, where it is very highly concentrated on a resource financial sector that provides little diversification to one's portfolio, okay? So we really like the active management part of the Canadian exposure within our smart beta portfolios, okay? So in this approach, we actively manage the funds that are weakly correlated with the core. So we're looking at correlation risk here as well, okay, which is very, very key. We're not just putting these two funds in for the sake of it. We're looking at correlation between the passive management and the active management to optimally achieve better returns versus their benchmark or their individual indices as well. So this is a quick example of the composition of our Smart Beta Plus portfolios and the offerings that we do offer. So for clients who are a little more conservative and do not want too much equity exposure, we offer a conservative portfolio that offers them 60% in fixed income with about 40% in equity funds as well. So 16% of that would be in the Canadian market, while 24% would be in foreign equity as well. Again, we're going to stick to that theme where we want a little more exposure to the US, global, international markets versus the Canadian market, because we do know that the Canadian market only represents about 4% of the world stock market capitalization. So we want to be able to have that foreign exposure within the respective portfolios as well. All right. Secondly, we do have our balanced portfolio. The balanced portfolio is going to give you some exposure to fixed income at about 40% with a 60% equity component. And again, equally spread out between the Canadian and the foreign, with a little more heavily weighted in the foreign exposure, as we've seen with the conservative portfolio. Likewise, the growth portfolio, we're looking at the overall fixed income now being drawn down to 30%, while increasing our equity exposure to 70%, with almost 50% being in foreign equity, 21% in that Canadian equity exposure there. When we get to the aggressive portfolio, we're really limiting now our fixed income at only 20%, with 80% in equities, and again, 56% in foreign equity and 24% on the Canadian side. Now, as for the actual fund holdings, as you can see here for the fixed income, we're very fortunate to have TOBAM, who manages the anti-benchmark global investment grade funds. We know that the global bond market is a lot more liquid than the Canadian bond market. So we're very fortunate to have that fund on our platform. TOBAM is actually owned by Amundi Asset Management, and they're based out of Paris, France. And we also have a global high yield bond fund as well that is also managed through TOBAM. When it comes to the equity exposure, we do have a really great low volatility US equity fund that is managed through our partners at TD. And we also have a low volatility global equity pooled fund trust, and also a emerging market low volatility fund. All right. So common theme in here is best risk adjusted returns in the marketplace for this particular portfolio is what we are aiming for. We know that the markets are volatile, so I really, really do love this particular product. When you're having discussions with your client, there's always concerns about the volatility in the marketplace. Having this as one of your core holdings within your clients' portfolios can definitely be advantageous, not only in an up market, but also on, more importantly, a down market. We know that a given return can take a substantial amount of years for the returns to be recouped on the overall return of your client's portfolio, okay? So on the fixed income continued for the Canadian exposure, we have Alpha Fix, which is a institutional money manager based out of Montreal, Quebec. And we also have Triasma, a Canadian equity, who really does a fabulous job in managing the Canadian equity fund for us. They use a 3-pillar approach that really is very unique in the marketplace to really offer you some great substantial returns versus its peers and its benchmark in the marketplace. So some of the advantages of a smart beta plus portfolio. So better diversification, again, is a common theme throughout this presentation by reducing the risk of concentration found in your traditional index funds. So for those who do like index funds, it is an excellent way to invest your clients' money. But like we know, there is certain risks that come with it, and being able to add a product that has a smart beta theme to it, where it does remove some of that concentration risk to your client's portfolio. It's a nice piece that you can add to a portfolio to reduce the overall risk of your clients' portfolios. One key thing too that is not really highly talked about is tax efficiency. So due to its low turnover rate of the portfolio. So what this means is if you have a non-registered account, you want to really try to look for funds that are highly tax efficient or more tax efficient than ones with a higher percentage of turnover rate, because there will be more capital gains to be paid within the portfolios, okay? So tax efficiency of this overall fund is ideal for your non-registered clients, okay? We're also going to be able to provide you reduced volatilities with the smart beta portfolio. We're also looking at fees that are generally lower than your actively managed strategies. So our MERs on this fund are highly, highly competitive. So if you are looking for a portfolio fund with a lower MER, this is definitely a portfolio that you should be looking at, okay? Again, better risk-adjusted return is what the overall theme of this strategy is, and an advantage of the portfolio itself. So a little bit of information from our portfolio managers. So our core or our smart beta is constructed, like I said, through TD using some of their low volatility securities. TOBAM, like I mentioned, they're based out of France in Paris. They've constructed a mathematical methodology that uses diversification as the key component of the strategy to the portfolio. The satellite or the plus active management, the Alpha Fix Capital generates a high current yield while maintaining a capital preservation of the client's principal. And like I mentioned earlier, Triasma is another Canadian institutional money manager where they use a three-pillar approach, which combines fundamental, quantitative, and trend analysis in a rigorous yet innovative investment process that remains consistent under different market conditions. So essentially, whether you're in a down market, up market, they're going to be able to adjust the fund accordingly to its current market conditions, okay? So those are the fund managers that are looking after the smart beta portfolio, okay? So TD, everybody knows that name, over 30 years of investment experience, over 388 billion in assets under management as well, 120 plus investment professionals. We've been fortunate enough to have TD on the road with us. When we initially did launch this particular product, they have always been very generous with their time and expertise, and they continue to support us. So if anybody ever has any questions that needs answering, please reach out to myself or a member of your sales team, and we can definitely get that question answered for you. TOBAM, as I mentioned, is based out of France. Again, that kind of boots on the ground for that global exposure is kind of the way we like to look at it. They've been around for since 2005. As I mentioned earlier, they are partly owned by Amundi Asset Management, and they have about 13.5 billion in assets under management, and they got over 53 financial professionals, 19 nationalities, in 4 offices across New York, Dublin, Paris, and Hong Kong. Okay. The AlphaFix component, as I mentioned, is a Quebec-based investment firm specializing in fixed income. Very, very important. When we did bring on AlphaFix, we really did do our due diligence and wanted to ensure that we are bringing the best of the best to our clients. So they have currently over $5 billion in assets under management with over 25 years of experience to the AlphaFix name. With Triasma, they are a Montreal independent investment firm with over $3.7 billion under assets and under management, and they average more than 20 years of experience and really do focus on institutional and private clients. We are very fortunate to have them on our platform. You can also buy AlphaFix and Triasma independently on their own within SSQ's SEG Fund platform. So your tools, as I mentioned earlier, we have some great marketing pieces that are available within the ssq.ca /investment for our investment components. There's some great marketing information on the smart beta strategy. They are client friendly, so this could be shared with your clients. We also recommend that you use our fund summary guide. This is going to provide you the guarantees, the fund codes for them respectively, and the different load compensation structures that are available within the SSQ platform. We have over 50 funds to choose from for your clients. So whether you like to use a portfolio fund as a key core holding within the portfolio, or if you like to construct your own portfolios, you can do so using SSQ's fund lineup. Some people like using the portfolio fund as the core, so for example, the smart beta, and then kind of building around that particular portfolio, adding some more alpha within the client's portfolio for some additional returns to the portfolio. We also encourage you to use the investor profile. We always want to make sure that your clients are invested properly, that it is compliant, and that they are on board and understand the risks with investing. So the investor profile will enable you to go through a questionnaire with them and find the investment that's best suited for them, whether that's conservative, a balanced, or a growth strategy. This will be able to help guide you in the right direction. So if you do need more details, like I mentioned, you can go under ssq.ca /smart beta plus, and there's more information on the smart beta funds, including the remainder of our fund lineup that is available. Okay, so that summarizes our or finishes up our presentation today. Sheldon, I think we have some questions. If you're able to access that, and hopefully I can answer those now.
Thanks, Sam. Actually, I have been answering a fair bit of the questions throughout the presentation itself. There were a bunch of questions at the beginning about the slides as you were going over our guarantees. People were wondering about the agenda and the slides, but there's been some more technical questions on the investment components that I've answered. Some people asked about the asset allocation. Some people asked about emerging market exposure. People would like copies of the slide deck. So the slide deck, I believe the slide deck is also shared when you get your CE credit. We include the presentation when we send the credits out to you. So anybody who wants a copy of the presentation, I'm pretty sure it comes out with the credits. So please be patient. You will get it from us directly. And if anybody wants to also look into rates of return and portfolio composition of our smart beta or any of our SEG funds, it is on our investment site. So either you have your secure access investment site or ssq.ca public site, or you can reach out to Sam, myself, or your regional wholesaler, wherever you're based out of, to speak to returns, and we can show you and we can get to you fund profiles themselves for the portfolios and all our funds with returns that you can use in your client presentations. Thank you.
Perfect. Okay, thank you, Sheldon, for that. So I think that will wrap us up for today when it comes to the Smart Beta portfolio. I hope to hear from everyone individually. As Sheldon mentioned, please reach out to your local wholesaler. They can provide you additional information, work with you on particular portfolios. Both Sheldon and I always are open to do portfolio comparisons for you when it comes to competitors. So if you are looking at a portfolio or up against another provider, we would gladly put a portfolio together for you and help you through that process. All right. Likewise, with the remainder of the team across Canada, would be more than happy to do that for you as well. Okay. Also, I also wanted to point out, I forgot to mention in the beginning of our presentation, SSQ does also have a private wealth division, all right? So for clients with a family net worth of 500,000 or more, it's not based on household criteria. As long as the family has over 500,000 of assets that are investable, whether that's registered, non-registered, we can have them under a private wealth with a lower MER, okay? So please look at us for your private wealth clients as well. We are highly, highly competitive, very specialized. You will be very impressed with the overall MERs and how low we can get them versus a mutual fund book and also a seg fund comparison as well, okay? So please look at us for the private wealth. Again, the team across Canada would be more than happy to help you with that, including myself and Sheldon, all right? Any other questions that have kind of stumbled in late, Sheldon, or are we good?
I'm looking at it right now. One moment, Sam. Constructed portfolios.
So
I think we are good with. I think we're good with all the questions. I think. I
see a question here. Sorry, Sheldon, by
okay,
Robert.
Please.
Yeah, Smithman. As long as the account is open before age 85, deposits can be made after age 85 with the 100-100. That is correct. So you can make up deposits up until the client's 99th birthday and still have that 100-100 guarantee. So as long as the account is open a day minus their birthday of their 85th birthday, so 84, they can have that contract open and make a deposit at age 94, 95, whatever the case may be. So that is correct.
And the question, two questions before, is by Dennis Kearns. With a named beneficiary, can we bypass probate? The answer is yes. Not sure which province you're in, Dennis, but as long as, you know, costs, as long as there are fees and costs attached to probating an estate, the answer is with a named beneficiary on the investment, be it a seg fund, be it a GIA, be it our high yield account, and the client passes away, the investment is liquidated directly to the beneficiary, and it does bypass probate and is not included in the overall estate. So thank you for that question.
Thank you. And that's in a non-registered account, right?
In a non-registered account, correct.
That's right. Yep. Yep.
There's a question here, Ray Knight, upper age restriction. If you're talking about a segregated fund, as Sam has just confirmed, our 100-100 can be open up until age 85. Our 75-75 can be open up until age 90. Our 75-100 can be open up to age 75. Our high yield account can be open to age 99, close to 100. And the GIAs, which is buying a GIC, a 1 year can be opened up to age 99, or a 10-year can be opened up to age 90. Of course, depends on the term itself. But the contracts those contracts will all expire at age 100.
Perfect. All right, thank you, Sheldon, for that. So yeah, I got a question here in terms of rate of returns in the smart beta. As you can see here on the screen, you can visit ssq.ca smart beta plus. There is a section once you're in the investment component for rates of return. So you can get that up to date on a daily basis in terms of overall returns of the individual portfolios, both smart beta and the remainder of SSQ's investment platform as well. Again, fully independent platform. We're a manager of managers. We're going to do what's best for our clients, ensure that your book of business continues to grow and bring value to your book of business. And I think we've done a really, really great job in being able to provide you a vast amount of different investment options dependent on asset class, geographical location, or sector. You'll be able to find that within SSQ's investment platform and not feel that you are confined to a particular fund without any other option. So again, I'd like to just thank everybody for their time today and joining us on our webinar series. I look forward to speaking to some of you in the coming days. And again, please feel free to reach out to us, and you should be receiving your CE credits within the next week to 2 weeks when it comes to issuing them. All right, thank you so much.
Thank you, everybody.